Hi, thanks for tuning in today. Welcome to the FX Scouts channel. We are starting a series on basic concepts that beginners might struggle with, and today's topic is on leverage. We're going to give you some very practical examples, and we're going to show you how to work out leverage and how this affects your trading. So enjoy. So what is leverage? Well, leverage is using a small amount of capital to gain exposure to a very large trading position. And this is via the use of borrowed funds. And in the case of Forex trading, it'll be borrowed funds from your broker. And it is also known as margin trading. They are often used in a synonymous sort of fashion. To simplify this, I'll explain it with an example. So if a company has insufficient funds, it may choose to borrow capital to boost its production and thereby boost its potential profits. But this can often increase its risks. And if the company is not doing as well as it hoped, it may actually have more debt than assets. And this is the same with leverage. It can magnify your potential profits, but it can also increase your losses. So with Forex trading and leverage trading in particular, very good risk management strategies should be employed. So how does leverage work in trading? Well, for example, a leverage of 10 to 1 means that the margin required to open and maintain that position is 1/10 of the transaction size. So a trader would require $1,000 to enter a trade for $10,000, as you can see on the screen. The margin refers to the trader's overall cost required to open that position. So if a trader wanted to make a $10,000 trade on a financial asset with a ratio of 10 to 1, the margin is $1,000. So if we trade on account with 30 to 1 leverage, where you've opened an account with $1,000, it works as if you were trading on that account with $30,000 because you multiplied the 1,000 by 30. And if you calculate that, every pip lost or gained on a micro lot, the theoretical loss is basically 10 cents. But with leverage, this becomes $3. So this means that if the trade goes negative by 100 pips, the trader will actually lose $300, which is 30% of the initial investment of $1,000. Which is a huge proportion of that investment. As another example, suppose we have $8,000 worth of Bitcoin, and Bitcoin costs $8,000 per coin. So if the price goes up to $8,050 the next day, then we have two options. As an unleveraged account, if you bought the contract at $8,000, you can take $50 gains by selling it at $8,050. If you've leveraged the account by tenfold and your contract of $8,000 is now $80,000 and you sell it at $8,050, you will then gain $500. So it's an enormous gain. But the same is true if you lose money. So say the contract now goes to $7,950. As an unleveraged trade, you will lose $50 on the $8,000 that you initially put in. But as a leveraged product, if you've leveraged it tenfold and it becomes an $80,000 contract and the price goes against you and lands at $7,950, if you sell that contract, you would have lost $500. So that's how leverage can multiply your profits, but it can also multiply your losses. Leverage is a very highly debated topic by many financial regulators. In fact, the maximum leverage is different depending on the regulator. So some regulators have leverage of up to 1 to 20 for Forex trading, and others allow leverage of up to even 1 to 3,000, depending on the broker. So the UK's FCA, for example, allows leverage of up to 1 to 30 on major Forex pairs, whereas the FSA of the Seychelles allows Forex trading of up to 1 to 3,000, which is extremely high. So how long can you keep leverage trades open? Well, this is dependent on you, but you have to be aware that you will have to pay overnight swap fees. And the longer you have your position open, so whether it's over a few days or up to a month, and you've borrowed money from your broker, you're going to have to pay a fee every night that trade remains open. So overall, as you can see from the examples we provided, leverage can increase your profits, but it can also increase your losses. Beginners in particular should be very prudent with how much leverage they use when they trade, and they should use a lower ratio initially, because a lower ratio means that they will be less likely to wipe out their accounts if they make mistakes and the trades go against them. Thanks again for watching today. If you enjoyed this video, please give it a thumbs up and subscribe. We're going to be posting a lot of trading related content, and we're going to be posting a lot of broker reviews so that you can find the broker that works for you. And you can send your questions through to fxscouts.com or tradeforexsa.co.za.